Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. equities market breadth, big tech capital expenditures, and latest price targets. This video presents a direct informational narration of the source document. Looking at our roadmap, we'll be moving through macro and economic data, tech capital expenditures, institutional price targets, market breadth dynamics, and finally, the technical market outlook.
Starting with Section 1, let's dive right into the macro and economic data, specifically focusing on geopolitical updates and the latest manufacturing PMI.
Looking at recent geopolitical developments, we're seeing a mix of signals. On one hand, Iran has submitted a new peace proposal aimed at ending the conflict. Concurrently, though, the U.S. is maintaining military pressure, and there's an ongoing dispute regarding a 60-day war authorization. On the trade front, U.S. tariffs on EU auto imports are set to increase from 15% to 25%.
Now, shifting over to inflation indicators, we have a significant data point right here, 84.6. The ISM Prices Paid Index surged to this level, which marks a notable four-year high.
While the broader ISM manufacturing PMI remained unchanged at 52.7, which was slightly below the 53.2 estimate, there are clear internal shifts. New orders actually increased to 54.1, but employment dropped down to 46.4. The primary drivers behind these price pressures are directly tied to ongoing AI hardware shortages and elevated energy costs.
That leads us nicely into Section 2, Tech Capital Expenditures, where we'll examine 2026 projections and free cash flow impacts.
Let's look at the numbers. The major tech companies are projecting massive Capex for 2026. Amazon is looking at roughly $200 billion, dropping their free cash flow outlook to about $1.2 billion. Google is projecting $180 to $190 billion, bringing their free cash flow down to roughly $10 billion. Meta expects to spend between $125 and $145 billion. Their free cash flow is positive but projected to turn negative in 2026. Finally, Microsoft is planning about $190 billion in Capex, pushing their free cash flow down to approximately $15.8 billion.
What the data here details is a clear risk of free cash flow depletion. Essentially, if revenue fails to outpace this massive level of spending, these companies face the potential need for debt issuance.
However, this aggressive capital spending serves as a direct structural tailwind for the broader hardware supply chain. The companies benefiting from this include NVIDIA, ASML, TSMC, Marvell, Broadcom, Qualcomm, and Micron.
Moving into Section 3, let's review institutional price targets and see the latest 12-month outlook updates.
Looking at the recent institutional updates, TD Cowen raised Amazon's target from 300 to 350 with a buy rating. Barclays also moved Amazon's target up from 300 to 330, maintaining an overweight rating. For Meta, Barclays raised their target from 800 to 830, also at overweight. Interestingly, JP Morgan adjusted Meta's target down from 825 to 725, shifting their rating to neutral.
Continuing with Google, Citi increased their target from 405 to 447 with a buy rating. Bank of America also raised Google's target from 370 to 430, keeping a buy. For Microsoft, Citi raised the target from 600 to 620, holding a buy rating. Barclays, however, lowered their Microsoft target from 600 down to 545, though they did maintain an overweight rating.
The key takeaway here is that despite these individual adjustments, both upgrades and downgrades, all of these institutional price targets remain significantly higher than current market prices.
Let's shift to Section 4, Market Breadth Dynamics, examining a very interesting divergence within the S&P 500. The current data highlights a significant narrowing. Right now, more S&P 500 constituents are down on the year than up, even as the overall index achieves new highs.
Looking at the historical context, we are presently observing this extreme narrowing. Historically, the average duration for this type of narrowing is about 3 months. However, the maximum historical duration extended beyond 2 years, which was seen during the 1990s.
Historically, this dynamic generally resolves through one of two paths. In Path 1, the high-flying stocks stall or drop slightly, while the lagging stocks surge to catch up. In Path 2, the high flyers drop significantly, while the lagging stocks rise slowly.
During these periods, high beta stocks typically experience above-average volatility. Intraday swings may increase to the 4 to 6% range. It's crucial to note, though, that breadth narrowing alone does not predict the overall direction of the index.
Finally, let's round out the date with Section 5, Technical Market Outlook, focusing on S&P 500 patterns and signals.
On the technical front, a stall pattern has formed at the top of the index on relatively low volume. Alongside this, intraday sellers have been spotted stepping in after recent rallies. Furthermore, the daily RSI is showing a clear bearish top divergence.
A critical level to monitor right now is 7,272. A close above this level invalidates the stall pattern, while failing to break it confirms the technical warming.
So, we are left with a critical question to consider based on the data. Will consumer tolerance for inflation allow market laggards to bridge the breadth gap, or will tech spending pressures pull the high flyers back down?